In today's video I will discuss the 5 money lessons I wish I had learned sooner. I hope they both save and make you money. Welcome to I Will Become a Millionaire. The first lesson I will discuss is pay yourself first. In the past, when it came to saving and investing, I would wait until the end of the month and use what was left. However, because I inevitably would spend my money on unnecessary items like fidget spinners or chocolate teapots, there usually wasn't much left to invest. I then learned to pay myself first. This involves setting up an automatic transfer of a specified savings percentage from your salary at the time it is received. In other words, it involves paying yourself before you begin paying your monthly expenses and making discretionary purchases. And where should you put this money? Investing is better than saving. While saving is important and you should try to have a cash emergency fund of 3 to 6 months of expenses, saving alone is not good enough. To illustrate this, as UK year-on-year inflation as of May 2021 is 2.1%, and interest rates that banks offer are negligible, then in real terms, your money is decreasing in value every year. Over 33 years, £100 put in savings would be worth just under half of its current value. This is a conservative estimate, as I believe that inflation is likely to increase due to increased levels of money printing and strong economic growth in the future. Alternatively, you can invest this money in an index fund such as the S&P 500, which averages a return of around 8% after inflation. After 33 years, this £100 would be worth around £1,200 in today's money, which would mean that the buying power of the same £100 would be worth around 24 times more if invested and saved. Another key part of this is to increase the velocity of money. The velocity of money, simply put, is the extent to which money moves from one entity to another. I will illustrate this concept in the following example. I received £10,000 from my employer. I invest this in the S&P 500 through a stocks and shares ISA, and it increases by 20% to £12,000. I then put 8,000 of this into my lifetime ISA over 2 tax years and receive government contributions of 25% or £2,000, which increases the total amount I have to 14,000. I then sell my 4,000 worth of S&P 500 shares and use the £10,000 in my lifetime ISA to put down a 10% deposit of 14,000 for 140,000 house. I managed to purchase the house for 10,000 below market value, gaining an extra £10,000 equity in the process. My net worth is now 24,000. House prices then rise by 6%, which they did in my region in the past year, which is an increase of £9,000. Taking the deposit amount to 14,000, the increase in value of 9,000, and purchasing the property for 10,000 below market value gives a total net worth of 33,000. The property is now worth 159,000, and I now have 33,000 equity in the property, giving me an 80% loan to value. I could then remortgage and use 16,000 of the equity for a 10% deposit for the new mortgage. I could then use the remaining 17,000 towards a deposit, legal fees and stamp duty for a 60,000 buy-to-let property, which I again buy below the market value of 65,000. I now have £16,000 in equity in my first property and around £19,000 in equity in my second property, having deducted stamp duty and legal costs. So the original £10,000 has now increased my net worth to £35,000, and I have 2 assets. Note that you should research the tax implications of buying properties in your own name rather than through a limited company if you are or expect to be a higher rate taxpayer. This brings me to knowing the difference between an asset and a liability. This is something I learned from Robert Kiyosaki's book, Rich Dad Poor Dad. Kiyosaki defines assets and liabilities as follows. An asset puts money in your pocket, and a liability takes money out of your pocket. People try to keep up with the Joneses by buying an expensive car that depreciates in value, or a massive house with no rental income and enormous upkeep costs, and they think that they have assets instead of thinking of them more accurately as liabilities. Understanding this concept could eventually allow you to retire if you have sufficient cash flow, as if you don't find a way to earn money while you sleep, you'll work until the ever increasing retirement age. The final lesson I want to talk about is compounding. Good and evil increase at compound interest. That's why the little decisions we make every day are of infinite importance. Compounding occurs when your investment earnings or savings account interest are added to your original sum, forming a larger base on which future earnings may accumulate. This can create a snowball effect, meaning that not only are your earnings/interest growing over time, but that the rate at which they grow gets faster as well. For example, using the average return for the S&P 500 from earlier of 8% would mean that if you invested £10,000 for 50 years, it would be worth over £500,000, having increased by more than a factor of 50. Read 500 pages every day. That's how knowledge works. It builds up like compound interest. I also believe that this applies to habitual pursuits of knowledge, like reading for example, because the more you know, the more you learn. The more you learn, the more you can do. The more you can do, the greater the opportunity. However, it differs from the compounding of investments in that the increase of knowledge produces more rapid progress because we learn by comparison with the predecessor, as well as drawing compound interest on all of the knowledge which is accumulated since the dawn of civilization. In summary, pay yourself first rather than last. Investing is better than saving due to low bank interest rates. Increase the velocity of money. Remember, an asset puts money in your pocket and a liability takes money out of your pocket. And finally, in the words of Einstein, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Please like and subscribe if you enjoyed this video. Let me know your opinions, questions and suggestions in the comments below. Have a fantastic day.